Thanks a lot, Connor. Well, some major Fox 50 stocks in the headlines this morning. For a closer look at our index, I'm joined by Jonathan Katz of Panagos Katz Situational Investing and Doug Flynn of Flynn Zito Capital Management. The headlines this morning, guys, tough. We've got some big names. Let's start with Microsoft.
Sure. Obviously they had a tough report. I think they're starting to cut costs, but ultimately it's a company with a massive market position and no debt. So.
But hasn't that been the story for 3 years? If I'm an investor and I hear you say that, I bought the stock 3 years ago for the same reason. I'm getting hammered.
Well, you have some big upside optionality in the sense that they're developing new product lines, right? They have limited pressure from the financial markets because they're sitting on a mountain of cash, and their costs they can take out of the business. So from my perspective as a restructuring professional, as a distressed investor, there's really no pressure on them aside from their equity
But
price.
Doug, the first job cuts, the company's founded in 1975. This is the first time they've had to cut jobs. Isn't that some sort of a red flag?
I think so. They don't normally come out and say we're going to get rid of everybody we want to get rid of in the first round of layoffs. So there's probably more to come there. The stock's sitting at a 52-week low. I think it's an 11-year low. Yeah.
Do you guys own any of the stock?
Do we own any of it? It is in some of our client portfolios, but it's usually legacy assets in there.
Let's talk about Google. Google looks, well, when I went to bed last night, it was good news. I know that it was up in the aftermarket, starting to fade a little bit, but they beat the estimates. What do you make of it?
Yeah, I mean, you look at the PE of Google relative to the market, and it's always traded at a multiple higher than that, and it's almost compressed to what the market multiple is now. So, the stock's been halved. Anything that's gone down a lot more than the market's down 37 to 40%. These things are down 50 or more percent. That may be an opportunity, but high tech, high growth stocks, we need some discretionary spending on a corporate and a personal level before these things are going to turn around, in my opinion.
But Jonathan, it's interesting because we talk about Microsoft. The company was incredible when it was founded, had a couple of things. It seems like lightning hasn't been able to strike again for a long time. Do you see Google sort of getting in that same position? They're fantastic at search, but what else are they good at?
It's a good question. I mean, Google's an interesting name in that they've been so successful. They've developed such massive market dominance that they've become, I think, a little fat around the edges. They're starting to take costs out, which is the right thing to do. I think there's a lot of additional costs that can be taken out of a name like that. But I would agree with Doug. I mean, it's sort of. Microsoft is much more of a bellwether with respect to the broader economy.
Right.
Google has a different business model that's really sort of internet focused and advertising focused. So, looking at a Microsoft, they'll flow with the demand side.
Right.
But Google has massive room for growth as the internet grows.
So speaking of bellwethers, GE, the ultimate bellwether, earnings out this morning, I guess more or less in line on the bottom line, missed a little bit on top line. What do you make of it? Yeah. The stock seems to be waffling here a little bit this morning.
Well, they came out and I think officially said that 2009 is going to be extremely difficult. So if you have that as as what you have on record, that's not boding well for the stock. Now, yield-wise, it's very high. The PE is very low. I think it's a 6 multiple. So you've got to take a look at it.
All right, we've got about 30 seconds, Jonathan. GE, the stock's down about 4.5% right now in the pre-market. You're a specialist here. What do they do to turn this around?
Well, GE is a good example of a company that actually might not exist in the sense that there's really no reason for a conglomerate to be if they don't have a financial advantage derived from their strength of balance sheet. If GE's balance sheet isn't strong enough to provide them with an advantage on their cost of capital, the company should be split into its constituent parts.
Doesn't look like they want to do that, but we've got to leave it there, guys. Doug and Jonathan, really appreciate it. Thanks a lot.
Yeah.